Right. Good afternoon and welcome everyone. My name is Wojciech Rzadkosz and this is Technically Speaking, how does Bitcoin actually work? We've already talked about blockchain and mining, Bitcoin address, transactions, wallets, block explorers. Today we're going to be talking about forks and exchange platforms. And we're left with tax and regulation and best practice for the next week. But before we go, I'd like to give a shout out to Grow at Green Park, where we are currently. It's a not-for-profit, community-driven co-working space. If you go business that needs a bit of room, come and check us out on this website. I'll be sharing the slides, so if you want them, just leave the email with me at the end of this survey. The survey is just there at the end of the table. It's just for me to know how I did, so I can improve for the next seminar. And there's going to be Q&A at the end, so there's going to be plenty of time to ask any questions. All right, without further ado, let's start with forks. Fork in general is a term loosely used to describe a change in a protocol or software. Or a situation where a network is temporarily or permanently out of consensus. Let's start with a consensus fork. A temporary consensus fork occurs naturally as part of mining operations, and it's something that we would normally not notice. It would be only miners who kind of are aware of this. And it occurs when, in a situation where two miners or more mine a block at approximately the same time, and then they propagate the block to the entire network. And because of the network size and latency, some nodes will receive one of those blocks first, and they'll reject the other as invalid. And some other group of nodes will receive the other block as valid, and they'll reject the other one. And the problem with that is that none of those blockchains, none of those nodes are wrong. So the only way to resolve that tie is to sit and wait for another block or two, and as blocks get added to either of those chains, one of them will eventually be longer than the other one, and the consensus rules will force the other group of miners to switch to the longest chain. So that will get resolved naturally in a space of 10 to 20, 30 minutes, most likely. If there is a consensus fork which is not resolved naturally, that's then called permanent consensus fork, and it occurs when there is a hard fork software upgrade, which we'll talk about. It can occur when there is a hard fork software upgrade, which we'll talk about in a minute. So the protocol fork is introducing some software upgrades that change the protocol rules or the consensus rules, and some of those rules can be implemented as a soft fork, introduced as a soft fork, and some of them can be introduced as a hard fork, and that's depending on the scope of those rules. So let's examine each of those separately. So a soft fork is a smooth way of introducing protocol changes because participants are not forced immediately to upgrade the software. They can upgrade at their own convenience. And generally, soft fork is a change in protocol rules that is narrowing down the limits further in those consensus rules. So things like decreasing the block size from 1 megabyte to half a megabyte, that would be a soft fork change. And in such case, the blocks valid by the new rules are a subset of blocks valid by the old rules, And what that means that the upgraded nodes will start producing 0.5 megabyte blocks at maximum, and that's far as the non-upgraded nodes are concerned, because it's still valid by the old rules. So there's no fork required to be able to do that. But once enough nodes upgrades to the soft fork, going back to the pre-fork rules requires a hard fork again, because that will be loosening the consensus rules. A hard fork is a more risky protocol change. It requires the entire network to upgrade at the same time in order for the network not to split. And a hard fork protocol change is used to implement changes that are loosening the protocol rules, things like increasing block size limits. So blocks valid by the old rules are a subset of blocks valid by the new rules. And a hard fork can easily result in a blockchain split, for example, Bitcoin Cash, if the entire network doesn't agree on the way forward. So what actually happens when a blockchain splits? A hash power is split between the two chains. There's abnormal that leads to abnormal block times, and until the difficulty algorithm kicks in and sort of does the accounting for the lost hash power. And that leads to potentially to congestion on the network and higher transaction fees. New asset is created, for example Bitcoin Cash, and it's airdropped onto the holders in proportion to their holdings. But the question remains, which fork remains the true chain and which is a spin-off? And that's not an obvious question to answer, because while in case where there's a group of programmers that just wanted to fork Bitcoin and do their own thing, and they didn't really manage to convince many people, many miners, and in that case it's fairly obvious, but in the Bitcoin and Bitcoin Cash community there is still disagreement as to which Bitcoin is the actual legacy Bitcoin and which is the spin-off. So what are the money airdrops I mentioned before? When a blockchain splits, so does their hash power and value, and that happens in proportion and in theory. So depending on, because the blockchain's value stems directly from its security, and that's related to its hash power. If we split its hash power, we split the value as well. But the problem is that there is usually some speculation-driven price inflation right after the fork. This may appear as if we are creating value out of thin air, but in fact, in time it turns out we're merely creating currency out of thin air. And in theory, the newly created currency sort of starts from scratch, or starts from the proportion of the hash power that's been able to accumulate. We need to be extra cautious when claiming a newly created cryptocurrency. And I'll just give you a quick example what can go wrong. It's quite chaotic right after the fork. There's usually no wallets that support the newly created currency. So it's hard to claim the newly created currency. So some people resort to some easy online solutions where you just need to paste your private key, and then they send you your fork currency, and that's fine. But you need to be aware that the single private key that controls the newly created currency, it also controls the same amount of old currency, which could be Bitcoin in this case. So the one way to avoid exposing yourself to losing this Bitcoin is by emptying the Bitcoin wallet first, right after the fork, and only then trying to claim your newly created currency. In that way, you're not risking losing your Bitcoin, which can be much more valuable. So what is actually the difference between the Bitcoin and Bitcoin Cash? So ever since the beginning of Bitcoin, there was the community was aware of scalability issue, the limitation on that the Bitcoin had imposed in the block size. That meant that Bitcoin at the time could only process few transactions a second, literally 4 or 5 transactions a second. Compare that to Visa or MasterCard, who can process thousands of transactions per second. This is nowhere near, obviously, a few orders of magnitude lower. So there was a debate how to scale Bitcoin, and the two main sort of ideas emerged. One of them was scaling off-chain, so building second layer solutions, and which would handle all the small transactions, and those would be only settled on the main chain, and that wouldn't require increasing the block size. And the other one was on-chain scaling, which meant that all transactions happen on the blockchain, but that would mean that we would need to increase the block size. So Bitcoin remains on 1 megabyte block size, and Bitcoin Cash has forked off to 8 megabyte block size first, and then 32 megabyte block size, and they committed to keep increasing this block size if needed. They forked off August the 1st, 2017, and it was a 1-to-1 fork, so 1 Bitcoin Cash for 1 BTC. That's not always the case. Sometimes it's an arbitrary choice actually by the programmers. Right, so let's move on to exchange platforms then. Exchange platforms are marketplaces, online marketplaces where cryptocurrencies can be bought or sold, and these are only a few examples of the exchange platforms. There is obviously already hundreds of them. So you need to be aware of a few things when you are choosing your exchange platform. And there's a few criteria to be looking at that pose the main differences between your choices, whether the platform is peer-to-peer or business to client, whether the platform is centralized or decentralized, whether it enables fiat or it's a crypto-only platform. And I'll talk about all of those types of exchanges. And later on, I'll try to take you through like a trading experience on a peer-to-peer centralized and fiat-enabled online exchange, which is kind of most common type and the one that you most likely end up on. So a peer-to-peer platform, you get best rates with minimum spread because you're trading peer-to-peer. There is no business doesn't take this. So the spread in business to client is part of their revenue. So they keep the spread. It's the same like the foreign exchange bureau. The difference between buy and sell, that's part of their revenue. So that's why, and they obviously run for profit. So that's why the price markup is much higher. Whereas in peer-to-peer, one of the peers gets to keep the spread. But the liquidity isn't always guaranteed on peer-to-peer exchanges. Generally, they could be applied quite widely. I just listed there for large amounts and day trading, but it could really be applied for most applications, and unless you want to buy very small amounts where this price markup doesn't really matter much, or very large amounts like over the counter, which means that you will be able to get even better rates than on peer-to-peer market due to those liquidity limitations on peer-to-peer markets. And examples of peer-to-peer: Coinbase Pro, Kraken or Bitstamp. And Coinbase Pro is kind of separate tool from Coinbase that caters the peer-to-peer trading. Coinbase is just a normal B2C trading, and Shapeshift and Changelly are other examples of B2C business model. We can also choose between centralized and decentralized cryptocurrency exchanges. Centralized are exchanges which hold the money for you when you are trading. So they are the trusted third party. You need to trust them in order to trade. And because they pool a lot of fiat currency and cryptocurrency, they become targets for hacks and thefts. So that there is vulnerability there. They're also run for profit, so it's going to be typically more expensive to trade on centralized than on decentralized trading platforms. But they have high liquidity in many currencies compared to decentralized, so that's a plus, and they're much faster than decentralized trading. The trade itself is instant, whereas in decentralized it's not instant. Again, most applications, unless you are trust conscious and you don't want to trust this centralized third party, then you can try and do decentralized. And I'm saying that because the decentralized are still, they pose a lot of limitations. So for example, only crypto to crypto, unreliable liquidity. There's only a few products really out there that allow you to trade in decentralized way. So the user experience is it can be quite poor and sort of difficult to do that. So unless you know what you're doing, you're probably going to end up on the centralized exchange. But the big advantage of the decentralized ones is the fact that they're trustless and you don't have to trust with your money to a third party. Examples: IDX or Ether Delta. And then finally, either fiat enabled, that enabled pound, euro, or dollar deposits, or crypto only, which don't allow those, but they only allow crypto trading and depositing in crypto. The obvious benefit of fiat enabled exchanges is that they allow you to trade the local currency. Maybe less obvious once the exchange wants to interface with the legacy banking institutions. They need to comply to some regulations like KYC and AML, so that provides some regulatory oversight and customer protection, which is good, but that comes at the cost of lost privacy, because to comply with those they need to collect personal data from their customers, like proof of ID, income, source of income, and things like that. The crypto only, they have lower or no KYC or AML, so that's gained privacy, most of them, or still a lot of them, although with the regulation clamping down on such exchanges, more and more crypto-only exchanges also want to comply with KYC and AML. For example, Shapeshift used to be completely private, and these days you have to comply with KYC and AML if you want to trade through Shapeshift some more significant amounts. And lots of them are still wild west of crypto, so poor regulatory oversight and customer protection. So again, most applications on this side, crypto only. If you don't require fiat trades, you only want to trade crypto, you already have cryptocurrency, or if you're privacy conscious, this is where you would go. Examples: Changelly, HitBTC, or Poloniex. They allow you to do that. So with all those choices, you still most likely arrive at this type of cryptocurrency exchange, which is peer-to-peer, centralized, and fiat enabled, and it's for good reason, because they provide actually a good compromise between convenience, rates, and security. And let me talk you briefly through the process of sort of when you will be doing trading on such exchange, what a process will look like. So first you need to sign up and verify, and that depends on how much you want to trade and how you want to trade, whether you want to use fiat or not. That's going to take longer or shorter, and there's going to be more documents required to provide or less. I'll explain that in a minute. Deposits in crypto or in fiat, then do the trade and then withdraw crypto or fiat. That's the process you will be going through. Before I talk you through each of those steps in detail, let me explain what a KYC and AML stand for. So KYC is a know your customer. It's a regulatory requirement to screen customers for any sort of illicit, to kind of manage risk of illicit activity going on. And KYC is a part of AML, which stands for anti-money laundering. It's again a regulatory requirement in place to prevent money laundering, and KYC really is a part of AML, but for the purpose of this seminar I'll refer to KYC as the requirement to provide your ID and proof of address, and AML the requirement to provide your proof of your source of income. So when you verify your account, at the entry level, so when you provide your email address, verify your email, lots of crypto-only exchanges will allow you straight away trade large amounts without providing further details. And then if you want to trade in fiat, you will only be able to transact in insignificant amounts, and that means in the order of magnitude of hundreds of pounds. Once you want to trade more in fiat, you need to comply with KYC, so you'll need to provide the proof of ID, usually with a selfie that they can compare to, and the recent proof of address, like a utility bill. And once you comply with that, you can trade non-trivial amounts in the order of magnitude of thousands of pounds, until you arrive at a point where you need to comply with AML. So you need to actually prove the source of your fund, of your income, and that then once you've complied with that, that allows you really unlimited trades. That entry level, it really takes a few minutes. KYC can take between a few minutes and even a day or two, depending on how automated the process is at the platform. And then AML can take a few days or even a few weeks sometimes, depending on how complicated your income structure is, because they actually need to go through the documents quite thoroughly and understand your source of income. And it varies between platforms. I've been doing AML with platforms who were very quick and not very thorough in checking my income, but some were very thorough and they scrutinized my income very thoroughly and asked for further information a few times. So that process took, even more than a month, sort of emails there and back asking for more and more information. So some platforms, are really diligent, and some aren't as much. The ways you can deposit or withdraw your money, you can do it via bank transfer, and it's fairly cost effective, but minimum limits can apply, and it may take a few days. You can do card payment. It's fast and convenient, but there is a payment processor fee, so it can be a little bit more expensive. And the most convenient, fastest and most cost-effective way is to deposit or withdraw in cryptocurrency. Trader's dashboard. So I should probably mention at this point that this is not specific to cryptocurrency. This is really just a sort of one-to-one carryover from legacy financial sort of systems, trading stocks, bonds, or forex currency. So if you were a trader before, that should be nothing new to you. But nevertheless, let me just explain briefly what those different parts of the trader's dashboard mean or can be interpreted as. So starting from a simple one, trader volume. or I should probably start saying that those candlesticks, each of them represents a period of time in the historic chart, price chart, and that period of time is defined here, and that one actually represents a day, but it can represent anything between a minute and a week. So that trade volume shows you a trade in Bitcoins over time for every period of time. Now, the price chart shows you the history of the price of the asset, and it can be displayed in many different ways. Most popular way is a candlestick price chart, and it's just a little bit more complete information than just a regular line chart, because it provides information about the lowest price of that period, the highest price of that period, and then the opening price of that period, so the first trade of the day, and then the last trade of the day. So it just provides a little bit more complete information on what was going on in the past. Order books and depth, that's important to understand the order books and the relation between the two. So the depth chart is a visualization of the order books, and they provide information about liquidity of the market or the trading pair, and they are very important to understand what they actually mean. And let me talk you through this depth chart a little bit more in detail. So this is an equivalent chart to the one you saw before. It's just rotated by 90 degrees. And on the left hand side you have all the buy offers that you will use when you want to sell, and on the right hand side you have all the sell offers that you will use when you want to buy. Horizontal axis is the price of the asset, and the vertical axis is the number of Bitcoins at a certain price. And the way to interpret this is I'll show that to you on an example. Say you want to sell 600 Bitcoins. So you'll start selling at $6,500, but 600 Bitcoins goes all the way up to here. And that will take you down to $4,900. So your first Bitcoin that you will sell will be $6,500, but your last Bitcoin that you will sell will be $4,900. So that's something to be aware of, because your average sale is going to be somewhere about here, $5,500. So that's $1,000 less than the current price. So if you just multiplied your number of Bitcoins that you want to sell times the current price, you'd be bitterly disappointed that you ended up selling £1,000 less. So that's like more than 10% lower price than what you were expecting. So that's why you need to pay attention to the liquidity of the trading pair that you're trading on, and the depth chart is the best way to do that. Is the way to see into the liquidity of every market. Now, this price here is the lowest sell price, lowest sell offer on the market. This price here is the highest buy offer on the market, and the difference between them is the spread. And the spread typically is taken by a market maker on a peer-to-peer platform. A market maker is a trader who makes liquidity, he adds liquidity to the market. So his trades, his orders, they're not filled immediately. They land in the order books first, and they wait for market takers to take them. And market taker is a trader who takes liquidity away from the market. So they use the orders that are in the order books to fill their buy or sell. And many platforms have a fee scheme, a commission fee scheme, which provides different commission fees depending on whether you are a maker or taker. So typically, makers pay less commission fee, and takers pay more commission fee. And that table just provides a few examples of exchanges that have the same fees for makers and takers, and or that have different fees for makers and takers. And by the way, this website over there, if you are not sure which trading platform to choose, you should definitely go and check out this report because it's very insightful about quite a few exchanges. Right, the last thing I want to talk about is algo trading. All trading platforms these days offer API access, which is application programming interface, and that enables implementing completely autonomous trading strategies. So it allows for monitoring activity across many markets simultaneously, reacting to market movements instantly, by buying or selling automatically, ensuring portfolio is balanced at all times, managing regular profit withdrawals, or managing your risk. So it is just a way to automate traders' work. So the traders don't have to keep watching the screens, monitoring and then interpreting all of the information, which they can't do anyway because there's just too much of it, and then press this trade button every time they see an opportunity. A lot of that, most of that, can be automated, implemented in a computer algorithm, and executed autonomously or semi-autonomously. So it's a big advantage. That is it for today. See you next week for tax and regulations and best practice, and as usual, drop me a line about anything. Thank you kindly, and I'm happy to take some questions now.